Why Alibaba isn't worth more than Amazon. Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. So recently, Alibaba has been on a surge. It's up 9% today. It's July 8th of 2020. And in the past week, it's up nearly 17%, a little over that actually, which is pretty incredible. Now, in my last video, when the stock was at only $219, I said, is Alibaba undervalued? And I made this comparison to Amazon as part of a comparative analysis. Alibaba was making more net income, its margins were higher. I was talking about the customer base throughout the Asian market and how it's a significantly larger customer base, and it's also going into the upper middle class really rapidly, etc. Their economy is booming. I talked about cloud growth, a bunch of different things, but the main thing was the fact that Alibaba was simply making more money than Amazon. It didn't make sense why Alibaba's market cap was so much lower than Amazon's. Today, Alibaba's is at $640 billion, and Amazon is at $1.54 trillion, which is pretty incredible. So I'm still bullish, and I still remain the same price target for Alibaba at $340. But I need to talk about possibly why Alibaba may never actually be worth more than Amazon, simply because of a lack of demand for people wanting to purchase and hold on to Alibaba stock. Whether it's fear, whether it's whatever it may be, we're going to talk about why that is, and let's talk about that. So, anyways, I also want to just point out here that Amazon stock has also surged to over 3,081, which is pretty incredible as it goes. And another thing that I just want to show here is the net income. So the first reason that we're going to get on here is simply the recent events. The pandemic affected Alibaba significantly more than it affected Amazon. Amazon did take a hit, but Alibaba had its factories directly shut down, its margins significantly reduced, as we'll see here. And because of that, its net income, which was previously actually significantly greater than Amazon's, dropped off, and now it's really underperforming what it was doing before. The growth is still strong. The CEO, it actually beat the expected earnings. Everything was still going great, but it just suffered in the Q4 for Alibaba of 2020. So the next quarter I think will really kind of bring back some of that investor confidence if it can raise that net income again to more than what Amazon, and kind of prove the point that I was making in the last video. But as of right now, the most recent earnings for Alibaba, its net income is definitely suffering. That said, it's still not that big of a difference compared to Amazon. Alibaba was just making so much more money because its margins were so much higher. But recently, its margins had really depleted, gone significantly lower because of the pandemic and a bunch of different costs associated with that, etc. Usually, it was around 30% to 20%. It plummeted down to around 5%, its profit margin. Amazon's, however, sticks at around 5%, its profit margin, which is why Amazon is making, in general, less net income than Alibaba, or at least in the past. So, now I have this little quote from their chief executive officer, Daniel Zhang. He wrote this in remarks to the latest earnings released. He said, our overall business continued to experience strong growth. So that's a really good sign. They had total active consumer base of 960 million globally, which has continued to grow significantly every quarter, despite concluding the first fiscal year with a quarter impacted by the economic effects of the COVID-19 pandemic. So despite that, they're still growing, and their customer base is growing. It's huge. It's nearly 1 billion people. I actually think probably is 1 billion people by now. The COVID-19 pandemic has really affected just investor confidence in Chinese companies, as well as the trade war that we'll talk about in a second here. So on top of this, another thing that you'll notice is simply the PE ratio. Alibaba has a PE ratio of 32.3, whereas Amazon has a PE ratio of 147.18. So the amount of people wanting to buy Amazon stock is just so much greater. I mean, its price is 147.18 times its earnings, whereas Alibaba's is only 32.3 times its earnings. Why is that, even though Alibaba's fundamentals seem to be significantly better, actually, than Amazon in terms of its net income, in terms of its margins? And although this past quarter they weren't, I do think that we'll return to how its performance was in either the next quarter or in a couple quarters very soon. We've seen Amazon really start to chug along here. It's actually benefited greatly from this whole pandemic. And although Alibaba suffered initially, I think it's going to start benefiting greatly as well. And I think we'll see that in these coming quarters. So besides the PE ratio, why is that? Well, the first thing is that in the United States, Amazon stock is simply way more popular, way more well known. The more people that know about Amazon stock means the more people that want to buy it, and the less people that know about Alibaba stock means the less people that are going to purchase it. So, or want to hold on to it. So as you can tell here on this Google Trends chart, I looked up Amazon stock, Alibaba stock. Amazon stock was way better or way more searched and prevalent than Alibaba stock. Same with their ticker symbols. Although Alibaba and the Amazon kind of fluctuating a little more even here. This is kind of a more specific term to look up, and Amazon is still further than that. And then when we just look up Amazon and Alibaba, just that term alone, well, Alibaba is almost non-existent compared to Amazon. So for regular retail investors, for people who maybe they're just investing there with their retirement account, it's more likely for them to ever to invest in Amazon than to invest in Alibaba. Even if Alibaba is making more net income, has great growth, has great opportunity ahead of it, well, they just don't know about the company. And because we're seeing that in the PE ratio especially. But there's also some other reasons for this. Number one, we have the trade war. It's an ADR in the S&P 500. So the trade war is the U.S. versus China trade war. It's created significant worry with U.S. investors to invest in Chinese stocks. There's not too much I need to touch on here. I think this is pretty straightforward. Trade war going on. The common sense for an investor would be to not get involved in Chinese stocks in case something were to happen, etc. So now let's talk about ADR, which is a little more complicated of a topic, but it's something that I really got a lot of comments and concerns about on the last video, which I thought was super interesting, because to me an ADR really isn't that big of a deal, but to a lot of people it kind of scares them off because they consider, oh, it's not a regular stock, and that's in quotation marks, or it's not whatever it might be. Just having this new term rather than just a normal common stock can really scare people off. And so in America, what an ADR is, it's an American Depositary Receipt. It's a negotiable security that represents securities of a company that trades in the U.S. financial markets. There's nothing wrong with this per se, but it scares investors off. And all an ADR really is it just makes it easier for American investors to invest in foreign companies. If we didn't have ADRs, what they'd have to do is go over, exchange your money for the Chinese currency, and then go to the Chinese markets and invest in their companies over there. So it'd just be a lot more difficult of a process. It just really simplifies the whole process. It doesn't really mean, it's not really necessarily a negative thing, but it does scare investors off. And I think the PE ratio really reflects that when compared to Amazon. Now let's talk about the S&P 500, because I think this is a significantly more prominent impact on, or for why the reason is that Alibaba may never be worth more than Amazon, and why it seems so undervalued compared to Amazon despite its fundamentals being really fantastic. So Alibaba is not on American indexes, which means large pension funds, retirement accounts, and other large funds won't be investing, which drives down the PE ratio. So this is just a little article or a little written piece here that I found by Pete Zeman. Apparently he's an investment management consulting. I don't actually know this guy, but what he wrote was pretty intelligent, and it was just, he made some really good points here. So I'm going to go ahead and read this. He said, no, it'll never be included in the S&P 500 because it's not an American common stock. Likewise, Amazon or Disney will never be a component of the Shanghai Composite Index. Alibaba is a Chinese company whose common stock is owned principally by Chinese investors and whose shares are principally traded on Chinese exchanges. The entire point of an index is to measure the behavior of discrete positions of the capital markets. If you want to know what's going on with the largest American companies and American investors, you might look at the S&P 500. If you want to know about Alibaba, Nestle, or Toyota, you need to look elsewhere. If you want all the world's large companies, look at the MSCI World Index for what it's worth. Personally, I wouldn't really pay attention to that too much. He even said it's not much, and I hardly pay attention to that. So BABA trades on the New York Exchange as an ADR, like other substantial foreign companies. ADRs are set up as convenience to foreign investors. They allow Americans to avoid the currency and tax hassles of buying stock on a foreign exchange. But Alibaba ADRs are a sideshow. The main event, the place where prices are set, takes place where the company and its owners live, China. This is a really great point. This is, I think, one of the biggest reasons why, although I still firmly believe Alibaba is undervalued, I think it's going to perform very well in the future. I think its stock price will continue to go up. I think the company will continue to grow. And I just think this is a reason why the PE ratio is so much lower than Amazon, and why it's just not, the stock simply isn't as in demand as Amazon stock is, even if Alibaba is making more net income than Amazon or has a significant bigger population to sell to, whatever the reason might be for its fundamentals, there simply just isn't enough demand for people wanting to hold and buy onto Alibaba's stock. And part of that, in my opinion, is because these large, big funds who generally buy these big indexes, well, Alibaba is not a part of those indexes, so it's not getting all those really large investors. So Alibaba may never be worth more than Amazon simply for this reason, but that doesn't change my outlook on it. I'm still incredibly bullish. I'm still sticking with my price target of 340. I think Alibaba is easily $1 trillion company, even with not being included on the S&P 500 or being an ADR or with the China trade war scares, whatever it may be. I still think Alibaba in the long run, and possibly in the short one I run as well, is an undervalued company. And well, this next earnings, which are coming up in August, I believe, are really going to tell us how the company is performing. We'll see if that net income returns to what it previously was, which was greater than Amazon's net income. Anyways, I hope this was some good points and just kind of an interesting little thing to clear up here about why Alibaba is not worth as much as Amazon. I got a lot of questions about, so I thought I'd just try to briefly answer it. Thanks for watching. Please subscribe. Let's hit 1,000 subscribers before the end of summer. It means so much. Make sure to check out these videos. Follow me on Twitter for more information and stock market news at StockerFinance. And I'll see you guys in the next video. Peace out.